Welcome back, everyone, to Money and Markets. We have discussed the causes of the huge rally in precious metals and some ways to take advantage of it. Now let's find out how the trade looks to money managers who are actively engaged in the market on a daily basis. Sean Brodrick is back with us. He's a small cap and natural resources specialist for Weiss Research and is the editor of the Crisis Profit Hunter newsletter. On set with us as well is John Browne, senior market strategist at Euro Pacific Capital. Joining us via Skype, Jay Taylor, president and CEO of Taylor Hard Money Advisors and editor of miningstocks.com. He's coming at us from Queens, New York. And from Irvine, California, we also have Julian, chief financial officer and senior market strategist at OpVest Wealth Management. Gentlemen, thank you to all for joining us today. We appreciate that. I want to start with a question from a viewer. Krista Gatos points out that gold prices usually decline in October. We haven't seen that this year, but she wants to know whether she should wait for a dip in the market or buy in now. John, I want to point that question to you.
Well, if she was a trend buyer, she'd be following this strong trend and buying now. If she was an accumulator, in ordinary times, she would be waiting for about a $50 correction. But these are not ordinary times. These are extraordinary times. We have a looming second banking crisis in sights. We have a currency war going on. We have a massive fiat finance deficits. And also technically, even accumulators are now only waiting for a sort of $5 dip. So if she doesn't want to be too greedy, both as a trend buyer and as an accumulator, she should buy now and just ride out any future dips.
Jay, what is your target for gold prices over the next month or two?
Well, you know, I really don't I don't really target any price. I think it's hard to say because it depends so much on the psychology of markets. We know that the fuel for inordinately high, you know, you can name your numbers in terms of gold prices going forward longer term. I do think we're due for a pullback. And so I suppose it's always good to have some cash. I'm actually holding a fair amount of cash because I believe we are going to have a major decline in the equity markets. And with that is likely to come a decline in the gold price and in the share prices. But the underlying economics look extremely positive for the gold shares. And so I would look at that as a major buying opportunity. But if you ask me within the next month or two where I think the gold price is going, I really don't have a clue, except to say I think we're due for a pullback of some sort here.
Andre, what impact, if any, do you think the November midterm elections are going to have on gold?
I think it's going to be huge. If you look at what's going on politically, especially with the quantitative easing, and you know the government is just consistently printing money. They're throwing more money at the problem, and what that's doing is really devaluating the U.S. currency. And coming through these elections, there are a lot of people right now that are banking on the fact that Republicans here in the States are going to take over, and you see a huge run up in the stock market because of that. So I think that post elections, once everything that's baked in the cake actually comes out, you're going to see a pullback not only in the equities, also a little bit in gold, but I think overall the gold is then going to continue on through the end of the year and actually outpace the market again. I think you see $1,400 an ounce by the end of the year without a problem.
Okay, let's go long term now. Sean, your new report is titled $50 silver and $2,500 gold. I guess the answer, the question here is about long-term targets. Why do you think that both metals can go so high?
Well, as has been mentioned here, and I hate the fact that I'm agreeing with everybody here, I'd much rather be a contrarian. But yes, we're having a currency crisis. Whether the governments of the world want to actually announce that or not, we're having a currency war. It's kind of turning into a crisis. And just to touch on one point, yes, we could see a pullback anytime, whether in gold or stocks, but the big trend is up. If we do see a pullback in stocks, it might not be as much as some people expect for the simple reason that, you know, they're priced in US dollars too. And so they can keep going up as the US dollar goes down. And so I have seen a breakout in stocks and in gold, and I am playing both of them longer term. And so, yes, I expect much higher prices next year.
We've already hit on some of the other precious metals in this show, palladium, platinum. John, I wanted to ask you about what's called the poor man's gold, I guess, and that's silver. What do you see there?
Well, silver is like 52 times cheaper than gold, and therefore is a poor man's gold, but it's more volatile because it's also used as an industrial product, and therefore depends on industry and the economy's growth rates. But silver is much more affordable and so relatively cheap that I think once the crisis spreads from people you might say who are in the know to people who are so far ignoring it and going about their daily business, they can afford $23 for an ounce of silver, whereas $1,500 is a lot to pay for a single ounce of gold. Yes. And I think when that mass market comes, you'll have huge demand to silver, and I think it will appreciate, it already has done this year, 420% in the last 10 years, and it's up about almost 30% this year alone. So I think the greatest bang for the buck would probably be in silver, but I would recommend a portfolio with 2/3 gold and 1/3 silver.
Sean?
Well, he just raises a great point, which is that most people are not glued into the market. I just opened up a Facebook account and made contact with all my old friends all around the world and stuff. And most of them have no clue about the precious metals market at all. The vast majority of the investing public is not aware of this. When that reaches their consciousness, you're going to see a big move in gold and in silver. And silver, yes, it is affordable. But like he also mentioned, it's an industrial metal. We've seen imports of silver into China increase 7 times in like the last 7 months. They just keep going up and up and up. They're using a lot more of it for electronics of all types, of course, but you use silver in so many applications nowadays. Everything from clothing to electronics to solar panels, and it's more and more useful. So we have these 2 demands pulling at silver, and I think it's going to be a big thing.
Say something on the long-term targets, which are almost the sky's the limit in many ways, because at the moment we're headed for a Weimar Republic type of economy at the moment. And in Weimar, Germany, you could buy a downtown block, an entire block of Frankfurt for a single ounce of gold. So we may not go to the Weimar, reach that limit, but what it says is the long term, nobody has any idea what the price would reach.
Okay, well, here's the most important question, I think, overall for investors. Where should they be putting their money when it comes to precious metals? Sean, I'm going to throw this at you. ETFs, mutual funds, mining stocks, bullion, where should you put it?
Well, it all depends on their risk appetite and their time frame. But if people don't know anything about the markets, then yes, use the ETFs like the GDX, which is a basket of leading mining stocks. Or else, if you want to go to individual mining stocks, I'd actually favor silver mining stocks at this time. So one like, SSSI. Silver Wheaton's just a pure play on silver. It's a wonderful stock. But just remember, when you buy the individual stocks, you are taking on the risk that an individual stock can blow up in your face. So that's why you might want to stick with the ETFs, at least until you know what you're doing.
Jay, to you now, where should the investors make their play?
Well, I agree with Sean that, diversification is very, very important. So there are a couple of ETFs out there, both in the gold and the silver space, silver mining companies. I think the real big money will be made with the junior exploration companies, the companies that are really finding the wealth in the ground. We've seen recently how Goldcorp went out and paid something like $900 an ounce for gold in the ground. And what happens, the senior mining companies cannot replace the gold they're producing. So they have to go out and buy up projects from the juniors. And the juniors are going out there putting high-risk capital in the ground because that's what they're made to do. And they come up with success stories. And it is an extraordinarily exciting time in this industry right now, as I'm seeing many of the juniors I've been following for the last number of years suddenly start to become producers. But I would say a diversified portfolio is very, very important.
Okay, John Browne, last question to you. I want to get into gold and precious metals. How do I do it?
Well, the investor should diversify his bullion holdings or gold holdings into 4 parts. First of all, the nest egg, which should be an allocated gold bars held in a bank which is still in the gold market. So when you sell it, you don't have to reassay. Secondly, at home or in the safe deposit box, you should have gold and silver coins. Thirdly, as investors, you should be invested in gold mining shares, but unless you really understand, as Sean said, the individual shares, then go for a mutual fund. And finally, for trading, you should be in ETFs.
Okay, that's all the time we have now. Sean Brodrick, John Browne, Jay Taylor, and Andre Julian, thank you all so much for your time. Thank you also to Jen Amos, Brian Rich, and Tony Sagami. If you have questions for any of this week's guests or suggestions for topics that you'd like us to cover, just email us here at weissmoneynetwork@weissinc.com. I'm Jamie Holmes, and now, Martin Weiss.
I think you need to make some basic strategic decisions, not only regarding the opportunities in precious metals that our experts talked about today, but also about a wide range of investments. For now, though, let's use gold as the illustration. And essentially, you have 3 choices. Choice number 1, you can strictly take advantage of the large, sweeping, sometimes explosive trends that have been driving gold higher for a decade and will probably continue to do so. For this long-term approach, physical gold, such as bullion coins bought from a reputable dealer, is a good vehicle. Choice number 2, you can play the shorter term market moves, which, by the way, can also be pretty large by historic standards. And for this, exchange-traded funds, or ETFs, that buy gold bullion for you, such as GLD, can make sense. Choice number 3, you can do a combination of both. In other words, you can earmark a percentage of your portfolio, your core long-term holdings, to follow exclusively the long-term trends, and at the same time, you can allocate another separate portion of your portfolio to trade those same markets more actively. Indeed, it's this third combined approach which we recommend for many of our readers and viewers. So let's see how this can work, still in the context of gold. Back in 1999, many of our readers acted on our instructions to buy physical gold bullion. They socked it away until someday in the future when we might issue a sell signal. And to this day, after nearly 12 years, we have not yet issued one single sell signal for physical gold. Someday we may, but probably not for a couple more years. Why? Well, because that simple buy and hold strategy alone has been enough to multiply the original capital by over 4 times. So there was no pressing need to trade in and out. Second, because the powerful long-term drivers behind rising gold prices have not only remained firmly in place, they've gotten a lot stronger. As we've been telling you here all along, the global fiscal crisis in the US, the UK, EU, and Japan is not getting better, it's getting worse. As we explained here just this past Monday, central banks are not learning more restraint, they're running their money printing presses faster than ever before in our lifetime. And as our experts explained again right now and today, all that new paper money is not going into the economy, it's escaping to gold, silver, virtually anything that can go up when the dollar goes down. So those are the big drivers behind our long-term strategy. Meanwhile, we've also been recommending trades in GLD, buying on weakness and selling on strength. I think you can do something very similar, either on your own or with our guidance. This is Martin Weiss from Money and Markets. Thanks for joining. We'll see you here again next week.